This is a bonus episode of the Rental Income Podcast. And now, Dan Lane.
It seems like there's been a lot of mortgage news over the last week. If you've been following the news, I'm sure you've seen a couple of stories about how mortgage rates are spiking and how the higher mortgage rates are making housing unaffordable for a lot of people. Of course, over the last year, we've all been dealing with a lot of inflation, and it seems like the rates are only going to be going up higher from here. The Fed has said they're going to raise rates 3 or possibly 4 times over the next year. So I thought it would be a good idea today to check in with Caeli Ridge from Ridge Lending Group to talk about mortgage rates, to see where things are at right now, and to see how this is going to affect us going forward. So let's take a really quick break to thank our sponsors. We'll come right back and we'll talk to Caeli. I want to let you know about a really easy way to track your rental income and expenses. It's an accounting software custom made for rental property investors. It takes just seconds to enter an expense or to record that you collected rent. It makes tax time really easy. Just run a report and give it to your tax person and you are done. They're currently offering a free 30-day trial. There's no credit card required, so if you don't like it, there's nothing to cancel. You can learn more and sign up today at rentaltrial.com. That's rentaltrial, T-R-I-A-L, rentaltrial.com.
Rental Income Podcast.
Caeli, I feel like a lot has changed with mortgage rates over the last couple of weeks. Why don't we start out with just a quick recap of kind of what's happened over the last couple of years?
Yeah, over the last couple of years, obviously, I would say that there are tons of variables that have dictated the up and down or volatility of where the long-term mortgage rates have found themselves. So if we start, pre-pandemic, rates were pretty high, right? I think that in general, when we talk about interest rates, this has just been my experience historically, people tend to have fairly short memories. I want to say that they were above 5 at some points prior to the pandemic. We were able to, the U.S. government actually did a very, very good job last year of really the quantitative easing, and what they were purchasing in mortgage-backed securities was astounding. Just to kind of give you a quick number, about $40 billion with a B a week is what the United States government was purchasing on the secondary market for mortgage-backed securities, and that's what drove interest rates down and kept them down. And then from then to now, inflationary concerns, economy is starting to pick back up and doing better. Rates are on the rise, right? The better the economy does, the higher the rates are ultimately going to be. I'm glad we're having this conversation about interest rate because I've got some perspective to give during our call today, Dan. But so increase above 5 pre-pandemic, real low. We saw some mid 3s, and this is for non-owner occupied. Post-pandemic, and now as we're kind of moving outside of that era, we're still historically low. We're going to be in the 4s now.
So right now, inflation is the real concern. So the government is trying to raise rates in an attempt to slow down inflation. Do I have that right?
Yes.
Okay. Now, there's lots of rumors that the Fed is going to raise rates 3 or maybe 4 times I guess, in the next year. But when the Fed when they talk about raising rates, that doesn't necessarily mean mortgage rates, right?
That is absolutely correct. So when they speak of that, they're talking about the Fed fund rate. This is an interest rate that is used between banks that is traded daily. This is a daily moving target for where banks will trade between themselves. And while there is a connection, there isn't necessarily a direct correlation. The secondary markets have a funny way of dictating to us, based on Fed's announcements and the language that they're using, how it will parlay into the long-term mortgage rates, the bonds on those. It's not always dollar for dollar. It certainly shouldn't be the only thing that someone is going to look at to predict rates. There's a connection, but it's definitely not anywhere near the same thing.
But do you feel like we're in a trajectory where the rates are going to be moving higher from here? The mortgage rates are going to be higher?
100%.
Okay. So So this is just a way to bring down inflation, right? Like that's the reason the rates are going to be going up.
One of them, sure,
Okay.
absolutely.
Okay. All right. Now, if we look at how this is going to impact us as rental property investors, higher mortgage rates are going to mean higher rentals. Higher mortgage rates are going to mean higher mortgage payments. So do you think it's going to be tougher to make deals work when the rates are higher?
So I really like this topic, Dan, and I'm so happy that you're bringing it up to your listeners. On the surface, of course, right? We think about higher interest rates. That means our payments are going to be higher, et cetera. But a few things I mentioned earlier, putting this into perspective. The first thing that I want to remind people of is that when mortgage rates move north, what happens to rents? The rents will follow suit. It's not going to happen simultaneously. It takes time for the two to catch each other. But 3, 6, 9 months, as we're seeing the long-term rates increase, the rental income will start to increase as well. So there is a catch-up. It'll get there. The other thing, too, I think is really important to shine a light on is that, when we talk about rising interest rates, putting it into perspective, largely based on the loan size. Now, remember, I'm not saying that interest rates aren't important to a real estate investment transaction. What I'm saying is that let's look at it from a mathematical perspective. The difference in payment between 4% and 4.5% is probably $30 a month. So is that going to be the difference between the deal working and not working? Almost certainly not. And if it is, there may be some other things you need to look at with that particular investment. And then lastly, remember too, we need to include a holistic approach when we talk about interest rates. One of the benefits of real estate investing is the tax deductions, right? So one could argue that the higher interest that you might secure on a deal results in more interest write-off or deduction on your Schedule E. So lots of things in there.
Sure. And, if you look at the economy and what's going on right now, I mean, there's a pretty severe labor shortage, and that's causing wages to go up. And if people have more money, they're going to be able to afford more rent. So do you feel like that's going to also be pushing up rent just because people are going to be able to afford it?
Such a good point. Yeah, that holistic thing that I was referencing, absolutely, that is another leg to that stool. Yes.
Yeah. And then also the other thing I was thinking is that there's also a housing shortage right now. We hear stories all the time on the podcast about people putting a rental up and getting 40 applications in the first day. So I feel like if that keeps happening, if you have 40 people applying for a rental or even looking at a rental, that's going to also push rates up. So push rents up. So I feel like we're in a good environment to be able to charge higher rents as landlords. So any increase we might have in rates is going to probably be offset.
I think it's going to be non-consequential.
Yeah. Well, let's put this all in context here. So we did a bonus episode on March 4th, 2020, and you were telling us where the rates were. And if you remember back to March 4th, that was right when the pandemic was starting. There was a lot of uncertainty back then. We didn't know where things were going, and we had just had a pretty big decrease in rates. And I wanted to play you this clip real quick where you talked about where the rates were. So let me play this for you here.
Okay. Let's focus on a rate and term refinance, which just simply means we're replacing one loan for a new loan. There's no cash back to the individual. The variables that I will use to quote a rate will be a single family residence, $100,000 loan size, 75% loan to value, and a 760 or greater credit score. I pulled these rates this morning, and I think people listening to this are going to minds blown. 4% on a 30-year fixed would be the rate lock today on those variables.
Wow. That is incredible.
Incredible.
And so if somebody bought a property, say a year ago, approximately what was the rate a year ago?
Yeah, good question. I pulled this up too. I knew you were going to ask me that, Dan. So similar characteristics. Now, granted, it's not a rate and term refinance. It's now a purchase. and looking at a variable of 80% loan to value, single family residence, 100,000 loan size. The rates pulling from last year this time were around 5.75.
Wow, 5.75 in 2019. And then at the bottom, or I guess at the start of the pandemic, 4%. So where are we today? Like as we record this here in January of 2020, where are the rates, or 2022, where are the rates right now?
So I just want to comment. I think this really crystallizes the point. One, people do tend to have short memories. I'm guilty of this myself. But listen to that. That's just that's incredible to me that we go from this to that and now here. Knowing that we were talking about rates today, I likewise had rates ready. We are locking, and I'm using the rate and term refinance variables. Remember, everybody, that an interest rate is very directly tied to the characteristics of the loan. These characteristics or variables are loan size, loan to value, property type, credit score. All of these things will dictate ultimately the interest rate. But on a rate and term refi, 100,000 loan size, 75% LTV, we would lock today at 4.375. So if I take that, Dan, what did we say last year? 4%?
4%, yeah.
So 3/8 of a percentage point, yeah.
So, I mean, and we were blown away. Like 4% was something we had never seen before. So we're really not too far off from where we were at March of 2020. So, I think the rates are still really really low. As much talk as there's been in the media about the rates going up, I think maybe we're just a little bit jaded because rates were so low for so long.
Spoiled.
Yeah,
Spoiled maybe.
Right,
yeah,
totally.
Yeah, and just to kind of put that into perspective and give them real numbers, listeners, that difference, 4% to 4.3 on $100,000 is a $22 a month payment difference between the two.
Yeah, so it's really nothing. Now, there was another clip that I pulled here that I think is interesting. We were talking about how to deal with rates going down and how the rates can be kind of volatile. And I want to see if this advice is still good in an environment where the rates are going up. So here's what you said back then.
When we get into places like this, you'll notice that there is some substantial volatility. Secondary markets are always relatively volatile, but especially when we're in places like this, when on a dime they can turn the other way and they go up faster than they go down. So I would caution everybody, if you're going to take advantage, man, do it. Pull the trigger. That's my advice.
So would you give the same advice today in 2022? Absolutely.
I think that it's a standing rule in mortgage when we're talking about interest rates. If someone's fixated on interest rates, waiting, it's Vegas odds, man.
Yeah, right.
It's almost always not going to work to your advantage. So if you're on the sidelines thinking that they're going to come back down, that is absolutely not my advice. It goes both ways. I would not wait. I would definitely get in and start locking in interest rates.
Now, to talk really short term, if you were buying a rental property and you maybe had something under contract, would you lock your rate today or would you let it float for the next couple of weeks?
I'd lock it yesterday if I could.
Okay.
And I need to preface by saying that the piece to that that's important is that the rate lock is typically good for 30 days. Now, you can lock on a longer rate lock period, 45, 60 days. The longer the lock period, the higher the rate will be. So locking too early before appraisal is ordered, or if there's appraisal delay, appraisals are taking 4 weeks, 6 weeks in certain markets, right? That we were seeing some of that. It'll be important to time it appropriately, because if you blow your rate lock, right? If you lock it on a 30 and that expires and we don't have an appraisal in or whatever may be happening, there are extension fees that will be assessed of 0.02% of the loan amount per day. So some things to just want to work through and identify before you lock in. But if it is a choice and we know that we're going to be within that lock period, lock immediately.
Okay. All right. So bottom line, rates are going to be going up, but they're still really good. I mean, this is still a great time to buy rentals, still a great time to refi.
I wholeheartedly agree with that. And rates are historically low still. We've already discussed the difference in payment between 1/8 or 3/8 of a percentage point. And bottom line, rates go up, rents go up. So there's really not a reason to hold or falter or second guess getting into the real estate game. If you're wondering when is a good time, it's a good time.
Awesome. Well, Caeli, thank you so much for taking the time to talk to us today. If anybody wants to follow up with you, if they have some questions or want to connect with you, what's the best way for someone to reach out?
Yes, sir. Thank you. It's always my pleasure. They can reach us a few ways. Our website is ridgelendinggroup.com. They can email info@ridgelendinggroup.com. And finally, please give us a call at 855-74-RIDGE, 855-747-4343.
Thanks for checking out this bonus episode of the podcast. Make sure you hit that follow button and you'll be notified when the next interview comes out. I interview inspiring landlords every single Tuesday, and if you're following the show, you'll get notified as soon as they come out. My name is Dan Lane, and this has been the Rental Income Podcast.